What we talked about before was a tax elimination strategy. And that's through structuring yourself in Puerto Rico, having your business essentially paying 4% tax, taking the dividends off the table, tax-free, capital gains, tax-free, all those things. So did that make sense, what we were talking about? If you have a business, again, so many different options. Even if you're a physician or an attorney or an accountant or any kind of professional, if you have an online business, there's so many different things that might apply to what you're doing, and to be able to take a portion of that business and set it up in Puerto Rico. Even if your business is based in the United States or somewhere else, you can take a portion of what you do. Again, even if you have whatever it is that you do, even if you're a dentist, and if you take leads, if you're looking for new patients and you put up a website to aggregate some new leads and things like that, you might be able to set that up in a place like Puerto Rico. That's a tax elimination strategy. We want to talk about another tax elimination strategy, and we want to go through this. Guys, put me 10 minutes on the clock. We're gonna have to keep cycling through this because we have a lot of information to cover over the next 2 hours. And what we're essentially going to do is talk about different topics: tax elimination, tax deferral, asset protection, and estate planning, all kind of back to back. And like I said, I kind of reserve the right to increase or decrease the allotted time for each one of those. That's why I didn't want to put specific blocks of time on the schedule. So I'm going to do my best to hold your attention for 2 hours on taxes. Let's see if I can accomplish that successfully. So, okay. The first thing we're going to talk about is another tax elimination strategy. And that is the foreign earned income exclusion. Now, this is only available to people that are living, this is specifically for U.S. taxpayers. This is for U.S. taxpayers that are living outside of the United States. If you're not currently living outside of the United States, it's pretty hard to take the foreign earned income exclusion. If you're thinking about moving outside the United States, we want to raise this as an option so you understand really what the benefits are of moving outside of the United States. The Internal Revenue Code, so we'll back up and say the United States is almost entirely unique in the world in that they tax their citizens on their worldwide income no matter where they live, including non-resident citizens. It's normal for most countries in the world will tax their residents on their worldwide income. So if you move to France or Thailand or many other places, you are going to be subject to taxation on your worldwide income. That's normal. That's the way it is in most places. Now, if you're a French citizen, even France, which has, we can joke about the onerous taxation in France and their punitive taxes they have there. Even if you're a French citizen, you move away from France, you move outside of France, and you go somewhere else, the French government is not going to tax you anymore. If you're Swedish and you move overseas, the Swedish government is not going to tax you anymore. If you're Canadian and you move overseas, the Canadian government's not going to tax you anymore. But if you're American and you move overseas, the U.S. government still lays a claim to your income. Now, what they do is they give you a portion of that tax-free. They call that the foreign earned income exclusion. And that goes up every year. Not that there's any inflation, but it goes up every year. For tax year 2015, it is $100,800. Last year it was less than that. This year for tax year 2015, and if it's 2024 when you're watching this, I don't know what it's going to be, but it's probably going to be a hell of a lot higher. $100,800. That means you're living overseas, you can generate earned income, foreign earned income, up to $100,800 and not pay tax on that. Now, we talked about the difference between earned income and other types of income. Unearned income, basically. Earned versus unearned, which is a weird way to think about it. Right? But this is all tax code stuff. In the tax code, they say, well, unearned income are things like we talked about in the last session. Investment income, capital gains, dividends, interest, these sorts of things that, if you're an investor, that's considered to be unearned income. So if you move overseas and you trade stocks, and you're living if you're a U.S. citizen, and you move to Panama, and you trade stocks, that is not considered foreign earned income.
That's correct.
And you have to pay tax on that. Might be long-term capital gains if you hold it for a year. Might be short-term capital gains, ordinary income tax rates, depending on what you're doing. But again, investment, trading income, that sort of thing is not considered foreign earned income. What is foreign earned income?
Again, it's income that you receive, either wages from a company, and that could be, we'll get to this, important, it could be, you could be working for IBM overseas, or you could be working for a company that you own overseas, or you could be working even without a company as a consultant if you're living in Santiago and you're a business consultant and your clients are paying you money. That's earned income. It all qualifies.
Right. So earned income is income that is earned through work, through labor, and through a business. So you could be, again, the idea then here is that you could own a business, set up overseas, you could be working for that business. If you're married, your spouse could also be working for that business, which means now the two of you could earn up to $100,800 each. So if you move overseas, if you have a business and you move overseas, through that business, you and your spouse could each earn $100,800. And that $100,800 would be tax-free. You still have to file a federal income tax return. U.S. federal income tax return must be filed. But there's a form 2555, and this is the foreign earned income exclusion form. And you work through that form, or your CPA works through that form. And basically, it means that you can take that first $100,800 tax-free.
And that's an important point, because the law did change a while ago. It's somewhat less valuable than it used to be. It used to be the last $100,000, so coming off the highest tax portion. Now it's the first $100,000. Any money above that, though, is taxed as if you had earned the $100,000. So
at a higher marginal tax rate.
At the higher marginal tax rate.
So
it's the first $100,000 that gets exempted.
Now, above the foreign earned income exclusion. So again, if you and your spouse, if you structure a business overseas and that business pays you, and if your spouse is also working in that business, and you and your spouse can both earn $100,800, now you've got $200,000 off the table tax-free. There's also the foreign housing deduction or exclusion. We won't necessarily get into the differences between the two, but essentially the Internal Revenue Code also allows you to take a lot of money off the table for housing. It varies depending on where you live. If you're living in London, there's a little chart.
It's revised every year.
Which is revised every year because these rates go up and down, exchange rates change, and so forth. There's a little chart that says if you're living in London, then the maximum deduction or exclusion you can take on housing is this. For example, I did it for Santiago last year. It was something like $55,000, I think, for 2013 and 2014, because the exchange rate had changed. The maximum deduction or exclusion actually decreased. But so you can take that as well. And there's another large chunk of money that essentially becomes tax-free.
Right, and again, I think for most people, obviously it depends on what lifestyle you choose to live, $200,000 tax-free plus housing covered is enough for most people to pay their
and live pretty well. Particularly
nicely.
if you're overseas in some fantastic place. It has a lower cost of living. It's a really great way to take a lot of that money off the table, put it in your pocket, tax-free, and not go to support bombs and drones and wars.
And that's an important point. That sort of, as we go through, several of these topics, many of you may have considered renouncing your U.S. citizenship. And it's a question I get from clients all the time. Should I renounce? And I'm like, well, I can tell you what the economic consequences are. I can't tell you whether you should or not. But I think what we're trying to show is that if you choose not to renounce your U.S. citizenship, and most people here probably won't, you can at least simulate the economic consequences of renunciation.
The benefits.
The benefits, while maintaining the option of living in the United States or visiting the United States if you choose to.
Right. So there's the foreign earned income exclusion. There's the foreign housing deduction or exclusion. then there are other options. What happens if you earn, maybe you and your spouse together, you earn, there's more money than $200,000 and you want to take that off the table? Now there's more options available.
And these are really basic things that are available to anyone, whether you're living in the U.S. or not. You can do things, and many of you may have done similar things. You can do an IRA or a larger, like a SEP IRA. You can, if you have...
What is a SEP, just in case people haven't heard that term?
It's self-employed IRA. It's very simple to set up. Any kind of financial advisor can do it for you. This year, you can put $52,000, if you're self-employed, $52,000 away, deductible right off the top. If you own a business and there are other people in it, it gets a little more complicated because you may have to include them as well. For people who have larger levels of income, you can go to sort of the next level, which is what's called a defined benefit plan, where the amount you can put away is actuarially based. But certainly have clients who've put millions of dollars away into their defined benefit plans, and that's all tax deferred.
So again, a number of options here. We don't want to get into the weeds of the foreign earned income exclusion. Just wanted to present this as an option. Just like Puerto Rico was an option to eliminate taxes, the foreign earned income exclusion does entitle you to eliminate a portion of your taxes, again, up to that $100,000, $100,800 level, or whatever it happens to be in the future when you're watching this. It also gives you the possibility of taking a substantial portion of your personal housing expenses off the table, and that being paid for by the business or deducting it from your taxes entirely. The Internal Revenue Code does require, it takes sort of a percentage and still taxes you on that, but it's a very small amount, and you end up paying a very, very small amount of tax, but the rest of it ends up being tax-free. So again, it is an option. If it's something that you are considering, I don't know that it's necessarily worth for people if you're based in the U.S. and you're comfortable there and you have your entire lifestyle there. I don't know that it's worth picking up and moving overseas just for that. If you're looking for, you know what, maybe it's time for us to go. We're not so comfortable here. I don't like the direction things are going. And maybe I'm looking to retire. I want to go abroad where my savings goes further. I want to be in a place where I can feel more free. I want to be a place where I can find more interesting opportunities. This is the extra benefit that's available to you. There is the possibility of taking a substantial amount of taxes off the table and eliminating that, and then achieving tax deferral by taking the portion above that $100,000 or $200,000 level and putting that into a SEP IRA or a defined benefit plan that can go up to.
And in terms of being prepared and planting flags, and we'll get to this in a minute, but if you're thinking that you might want to move outside the U.S. at some later point in your life, could be dependent on job or kids or whatever it is. You can think about setting up a foreign company now, getting it up and running, having it, starting to generate revenue, and then when you move overseas, you can start to take a salary for running it, and then the foreign earned income exclusion is all set to go. So again, it's a matter of sort of thinking ahead, preparing, and then you have more options.
Okay. I saw a hand go up somewhere, and I want to save most questions for later in the day, but if somebody has a specific question about the foreign earned income exclusion. Okay, thanks, great question. To qualify for the question is, how many days do you have to be out of the U.S. to qualify for the foreign earned income exclusion? And all this is available, again, the form that you want to look at is Form 2555. And all this is there, it's in the instructions. Now, there are essentially two ways to qualify. One of the ways is what they call the physical presence test. And I forget the exact number. Is it 28 days? Or it's roughly about a month or so in the year that you can spend in the U.S. and maybe 335 days, something like that. I forget the exact number. But the vast majority of the year, you have to be outside of the United States. It's only about 30 days or so in the country in the United States.
And that's actually harder to meet than 303 days because partial days count as full days. Right. So if you fly in...
If you're in Cancun... and you connect through Houston on your way to London, where your residence is, they count that as a day because you get stamped into Houston. Even if you leave 2 hours later, they count that as a day. So you really have to be gone a lot to meet the physical presence test. The easier test to meet is the bona fide residence test. The bona fide residence test is, again, like we were talking about in the previous one, it's the totality of circumstances, that closer connection test. Do you have bona fide residency somewhere? Are you really in good faith living in London or Paris or Buenos Aires or Santiago or Panama or any of these places? Are you really living there, or is it just sort of on paper? So what they want to see is, again, do you have a home, back in the United States? Where's your family? Where's your stuff? Where do you vote? Where's your driver's license? All those sorts of things. Put yourself in the mind of a tax bureaucrat and the things that they would, really look at. By the way, Rob mentioned this earlier. If there happens to be anybody here from the IRS, which there probably is, Rob would like to buy you a cup of coffee a little bit later and talk shop. Yeah. So he'll be around afterwards, so you can schedule some time with him.
And again, that test is a calendar year test. You need to, sometime before midnight on December 31st, have planted yourself in your new location. Again, it has to be your primary residence.
Right.
You also, we talked about the idea of tax home before. Your tax home needs to be overseas as well. So you're running your business from that place, and that needs to continue all the way through the end of the year. The other test, the quantitative test, is on a rolling 12-month basis. So that can start at any time during the year. The test also, and this is important, it comes up a lot, we always sit here and we talk about federal taxes a lot. For those of you who live in very high tax states like California, you also, and this can be tougher, believe it or not, it can be tougher to get out of your California tax residence than to establish foreign residence for federal income tax purposes. They are going to want to see that you have left California and have nothing there that shows an intent to return, or Governor Brown's going to keep taking a chunk of your paycheck.
Right. So again, the bona fide residency test is easier to meet, and one of the things that's very helpful is what we talked about in the panel yesterday, going and actually establishing legal residency somewhere, whether it's Panama or Belgium or Chile or St. Kitts or anything else. Actually going and establishing bona fide, real, actual legal residency somewhere goes a long way, certainly, in because there's a question on the 2555 that basically asks, are you required to pay tax, or have you filed with the local authorities that you're not subject to tax?
That you're not subject to tax. Yes, it's different. Again, it's not necessary that you have legal residence. Yes, it's a positive factor, but there are some places where they sort of, when you apply for residence, they say, is there a reason why you wouldn't be subject to tax here? If you answer no, yes, that's a real problem for the foreign earned income exclusion.
Right. So it makes sense to get legal residency somewhere. And in that case, then if you can meet the bona fide residency test, there's not really a number of days that you can spend in the U.S., but it's something, I, for example, on my 2555, I'm under the bona fide residency. I have Chilean residency. I've qualified for permanent residency. I have a home there, all my interests and so forth there. And I travel a lot around the world as well, but I can sort of say that I have this tax home in Chile, which I do, and I've got a lot of connections there. But I don't count the days. I don't worry about the number of days I spend in the U.S. in that case. It runs over 30 every year. Not a whole lot over 30, but it still entitles me to deduct that $100,800.
Yeah, for the first year or two, I'd be conscious and keep it low. Over time, again, once it's clear that you've been living in a place for a long time, you have a lot more flexibility, and if you want to come back for family events or business reasons or whatever, it's fine.
And certainly, if you're spending 6 months or more, that's probably not a
good idea,
and not going to qualify for it.